terms of IFRS 9. Unless it has significant influence, then it might be an associate. Are you with me? So remember those two options. If you're one of the other three parties, okay, you might have such a small investment. Let's say your interest is 5%. So you don't have significant influence, you clearly don't have joint control, and you clearly don't have control, so you've got a simple investment. How do you measure that? Either at fair value, where however IFRS 9 allows you to recognize that investment. Do you agree? At fair value through profit and loss, at fair value through other comprehensive income, you know, according to the amortized cost model, which wouldn't really be applicable here. So what is important? IFRS 9 takes over if you're one of the three parties. Unless, what is the only one that we haven't tested? If you're not one of the controlling two parties, so you're not one of these two that control the joint venture, you're sitting on your own, but you have an investment of, let's say, 25%. That gives you significant influence. Or you can appoint a director to the board of directors if that separate vehicle is a company. Then you've got representation on the board of directors. What does that give you? For your 25%, you have significant influence. And then you might also end up equity accounting that investment. So can you see, because you will be equity accounting it as an investment in an associate, whereas one of the two parties that control the joint venture will be equity accounting it as an investment in a joint venture. All right, so remember that. One of the other three parties, they can only sort of use IFRS 9 or IS 28. One of the two, depending on the level of their influence. Do you still remember what you can do if it's a joint operator? The joint operator, the two parties that control, do exactly the same as the three parties that don't control. Can you see what I'm saying? All right, all of them will be just including their percentage of the assets and liabilities that they are entitled to or obligated for. And that's how it happens. So it's going to be different percentages, different assets, different liabilities. Everybody accounts for their proportion, whether you're one of the two controlling parties or one of the three parties that are just party to the joint arrangement. There's no difference with a joint operation. But on this slide, number 23, you can see joint ventures, the two controlling parties will be using IFRS 11, accounting for that investment according to the equity method, and the other three parties will either be using IS 28 or IFRS 9, treating it as a normal financial instrument when it is a simple investment. All right, let's move on to slide number 23. If the joint arrangement is classified as a joint venture, the investor will account for the investment in the joint venture in terms of IS 28. That's what we said, investments in associates and joint ventures, which means that the investor will apply the equity method to its investment in the joint venture. The equity method is a valuation method for the investment in the JV based on the proportionate net asset value, i.e. equity, of the joint venture. And just to quickly remind you of the journal entry relating to the equity method, remember, when you buy your investment, you will say debit investment in joint venture, credit bank. That is the cost price of your investment. Do you agree? From there on, the subsequent measurement will be the equity method. So you're going to have to see, by looking at the growth in all of your equity categories since the acquisition date and only your percentage. That percentage must be accounted for in the relevant categories of reserves. So if you look at the basic journal entry, debit investment in JV, credit retained earnings at the beginning of the year. So that means your 40%, for example, of the growth in retained earnings since acquisition to the beginning of the year, that is what's credited. Because that is indicative of the growth in the net asset value since acquisition, not at acquisition, since acquisition for your 40%. Then you look at mark-to-market reserve. Then that means what is the growth in the mark-to-market reserve since acquisition to the end of the current year, okay, at your percentage. And that is indicative of the growth in the net asset value. So we credit that to mark-to-market, and that adds to the revaluation on the investment side. Do you agree? And the same for the revaluation surplus, the same for the profit in the current year. You know, that whole issue from income from associate or share of profit of associate. Now it's going to be share of profit of joint venture. Do you agree? So the current year, we can never just credit retained earnings. Because remember, the moment that you are dealing with retained earnings, you are only dealing with prior years. If you are dealing with the current year, you must be able to put P&L in brackets after the account that you use. So the increase in the current year's profit, let's say the profit for the current year was 100,000 Rand, you own 40%. Where do I take that 40,000 Rand increase? That's on the credit side. I'll take it to share of profit of joint venture. And that's going to be reflected in the debit to the investment as well. So the equity method is actually just a revaluation. If you think about revaluation of property, plant and equipment, how does that journal entry look? Debit, land, credit, revaluation, surplus. That is very similar to this journal, except for the growth is not just indicated in the reval surplus. The growth is indicated in reval surplus, mark to market, retained earnings, share of profit of joint venture, etc. And all of those growths together, the total of the sins column, is going to be added on the debit side of the investment, because that shows the growth since acquisition in your 40% investment. All right, and we break down all the reserves in which the growth has happened. Slide 25, separate financial statements. Now, ladies and gentlemen, this is quite important for you to have a look at, these separate financial statements, and this is what we've spoken about in a previous chapter and a previous lecture as well. Separate financial statements are those that are prepared by a parent. So you can write that down. If the entity prepares separate financial statements, you can actually just highlight it on the slide, i.e. it is a parent to other subsidiaries in the group. The accounting for joint arrangements in the separate financial statement is different. It depends on the involvement of that entity in that joint arrangement and the type of joint arrangement. Now let's have a look. So this means you'll see what we've spoken about up to this point is when subsidiaries are not part of the picture. Do you agree? Now subsidiaries come into the picture. So now this parent has a subsidiary, but it also has a joint venture or a joint operation. That's what this slide is all about. Now remember, because the parent has a subsidiary, the parent is going to be preparing separate financial statements, not individual, and also consolidated financial statements because of the subsidiary. Do you agree? So now the issue is, how do you measure this investment in the joint venture or the joint operation in the separate financial statements before you prepare the consolidation? Now it says here, if the entity prepares separate financial statements, the accounting for joint arrangements in these separate financial statements will depend on the involvement and the type of joint arrangement. If the entity is a joint operator in a joint operation, it shall apply the same principles as above. So then there's no difference. In its separate books, in the separate financial statements, this parent will still just include the percentage of assets that it's entitled to, the percentage of obligations that it has an obligation for, or that it had, the percentage of liabilities that it has an obligation for. So we're going to, either apply the proportionate consolidation method if we have a percentage share in every asset and liability and it's the same percentage, or we're going to almost like apply a different version of the proportionate consolidation method, as we discussed before, where you're going to bring in your percentage of the assets, your percentage of the liabilities, and only the relevant assets and liabilities that are actually affected. All right, so that's how that's going to work. It's going to be the same. So what can you learn from here on? In the separate financial statements in respect of a joint operation, if this parent is a joint operator, no difference in how it's treated. Now let's look at the joint venturer. If the entity is a joint venturer in a joint venture, it shall apply paragraph 10 of IAS 27 on separate financial statements, being that this investment in the joint venture can either be measured at cost or at fair value in terms of IFRS 9 financial instruments. All right, now what do you see here? In the separate books, an investment in a joint venture cannot be equity accounted. This is very important, because if you go look at IAS 27, you will see that an investment in an associate in the separate books of a parent can also not be equity accounted. So what does this mean? You can only equity account the joint venturer if the parent is just an investor, so it's not a parent actually, so it's just the investor that has an investment in the joint venture, so that investor has individual financial statements. Do you agree? Or you can equity account if the parent prepares consolidated financial statements. Now this is very important because you must know which method to apply to which set of financial statements. So the equity method here may not be applied to an investment in a joint venture in the separate books of the parent. All right, now let's have a look here. If the entity is a party that participates in but does not have joint control, and if this is now one of those three, if they are a parent, for example, of another subsidiary, what can they do in their separate books? If it's a joint operation, once again, no difference. Joint venture, IFRS 9, unless significant influence, then IAS 27 paragraph 10, because then it's an investment in an associate. So what are the rules that you need to write down here, ladies and gentlemen? And I would make sure that I understand this very, very well. In the separate financial statements of the parent, an investment in a subsidiary, an investment in an associate, and an investment in a joint venture cannot be equity accounted or measured at fair value. It cannot be equity accounted, okay? So this means it can either be measured in the separate books at cost or at fair value. Very important. So the equity method is out in the separate books of the parent, okay, for an investment in an associate and an investment in a joint venture. All right, you're not going to equity account an investment in a subsidiary anyway. So that's not even a risk to consider, but we know you can't equity account an investment in a subsidiary either. That's full consolidation. But the risk is for the equity accounting method on the investment in the associate and the investment in the joint venture. That can only happen then in the consolidated financial statements that will follow the separate financial statements of the parent. So that's very important to remember. Okay, so how can we summarize the rules? When you're busy with individual financial statements, you don't have a parent. Do you agree? So you don't have separate financial statements. There, you use your proportionate consolidation method, your percentage of assets and liabilities for a joint operation, and you use the equity method for a joint venture. If you're looking at the investment, if you're looking at a joint arrangement in the books of a parent, okay, so these are not individual financial statements, they are separate financial statements because they precede the consolidated financial statements, okay. And listen carefully, in the separate financial statements of a parent, an investment in an associate and an investment in a joint venture may not be equity accounted, but may either be carried at cost or at fair value. Okay, and if it's a separate, if it's one of the three entities that is actually a parent, okay, once again, people, I want to warn you about the other parties. You can see that that is the theme in IFRS 11. If you ignore these two parties that jointly control and you look at the other three parties, for example, in the joint arrangement, the test is always, don't they possibly have significant influence? That's the important thing. Because the fact that they don't jointly control, that doesn't automatically make them a simple investment. You'll find that most often they will be simple investments, let's say 5%, 10%, 15%, something like that. They won't be significant. But there is the risk that the other three parties might have significant influence. And immediately then you are also in the position where if one of those three is a parent, so it means they have another subsidiary somewhere else, they are not allowed in their separate books to equity account the investment in the associate. The only time